What if you lose your job tomorrow? Will you be able to sustain yourself for an entire year? What about 2 years? What about 30 years? That's exactly what happens when we retire. We will have zero active income in 25 to 30 years, and we will still have expenses for the next 20 to 30 years that we are alive after retirement. How do we plan for this? That's exactly what this video is all about. This video will be the most important video that you watch on my channel in the past, present, and the future. So let's get started. If you are new to this channel, my mission is to retire 1 million immigrants with $5 million. To join this mission, all you need to do is subscribe to the channel, and I promise you that I'll be bringing a lot of value that makes you and me a lot of money. Now, retirement is a topic that a lot of people, including me a few years ago, was in denial of. This is something that we don't want to think because it stresses us out. Everyone has different circumstances. Now, this particular plan that I show you today is the most basic that I feel everyone who wants to retire in Canada can follow, but this is still based on my situation, and I'll give you all that context. So in today's video, I'll be talking about how did I assess my retirement needs. Then I'll break down the portfolio stocks versus real estate and how it grows into my retirement. And finally, I'll also talk about protection, where what if while I build this portfolio, what if I die early? And we'll talk about all these three things just to make sure that we are well set for our retirement. Now, when we are planning for our retirement today, we need to ask a few questions to ourselves, because our number and our plan can be very different if the answers to these questions are different. Number one question that we need to answer is, what is our number? For example, my number is $5 million, and I'll talk about why $5 million. Is that $5 million in cash? Is that $5 million in assets? I'll talk about that in my subsequent slides, but my number is $5 million. If you are someone who's retiring in India, this number can be a little bit lower, but we'll get to that. The second thing that we need to ask ourselves is, why is that your number? What do you need from this $5 million? Is that freedom? For most people, I think it will be freedom. For most people, it will be peace of mind. For instance, after 60, I may not be capable of working. After 60, I may not want to work. After 60, I may want to enjoy life, with family. It could be any number of reasons. For me personally, I do want to retire before 60, and the major reason is financial freedom, which basically means that I don't have to work actively for anything, for money, and I have enough assets that pay for my retirement. And even if I don't work, or I can choose to work on what I like, and I don't have to worry about money that comes in every single month. And that's the freedom that I'm buying with $5 million. Now, the third question that you need to ask is, when do you want to retire? And my answer to this is 25 years. Now, if you are 25 and you want to retire at 55, that number can be 30 years. I am 37 and I would want to retire at least when I'm 62. Which is 25 years from now, and therefore this number is 25 for me. Now, if you are someone who is watching this video in mid-20s, congratulations, you are way ahead of everyone else, because at least if you are 25, let's say in your mid-20s, you are 12 years ahead of me, and you have 12 more years to invest and plan for this requirement. Kudos to you. I don't know what I was doing at 25, but in the next 25 years, I want to achieve my financial freedom number, which is $5 million. Now, the fourth question that we need to ask is, where do you want to retire? And my answer to this is Canada and not India. For a lot of people who have come from India, they want to retire in India. But my justification for this is, if I've lived here for 15, 20 years, heck, we have lived here for only 4 years, and our entire social circle, our entire, even my family is now in Canada. And I don't think in 25 years, I'll have anything to go back to in India. And that's my justification for why, even though I feel that I want to retire in India right now, I don't think I'll do that. Plus, if you are someone who has kids, their life will all be built, and it actually starts in Canada, and they would want to live here, or at least not go back to India, because that's not where they feel they belong to. Now, that said, this is just my answer, and yours can be very different. In fact, if your answer is India, I have actually made another video that will help you understand how to retire in India. I'll link that in the description below. But like I said, my answer is Canada. And the fifth and the last question that you need to answer is, how would you achieve it? Would that be a mix of stocks? Would that be real estate? Would that be a lottery? Would that be cash under your mattress? How would you achieve that? My answer to this is a mix of stock and real estate portfolio. Now, before I break down my retirement, I want to talk about this 5 million number. Where did I get it from? So, what's my retirement number? It's a very specific number, $5,189,800. Why is it so specific? So let me just go back to an Excel. Now this particular tool is available on my website. You can download from Money Tools. The link will be in the description below. It's a fourth link there. And this particular tool actually helps you assess what your retirement number is. You'll see that 5,189,800, the number that I had on my slide, that's how I got this number. Now let's talk about this particular Excel sheet. Now I started doing this when I was 32. Like, I started investing and I started looking at, this Excel was actually made a couple of years ago as well. So I started doing that when I was 32. That's around the time when we came to Canada. I think a little bit, around that time. What age do you plan to retire? It's 62, which is 30 years from now. These numbers probably don't matter. I would love to live till 100. I think with the advancement that are happening, there's a very high chance that the average age actually increases to about 100. Active work years left is basically 62 minus 32. So I will be working and earning and investing for the next 30 years. And after retirement, I have about 30 to 40 years left. And that's crazy. I've taken inflation numbers to about 3% because the expenses that we take today, everything will, increase because the car that costed or, this perfume bottle, everything will grow with inflation. And I've taken a 3% inflation number. I think it's very conservative. So that's why this 5 million number is also very conservative, but I'll talk about that in a bit. This is the least that we need to do. Now, I've listed down all my expenses right now. And you would say that why do you have rent and mortgage as $0? The reason why I have it at $0 is because I intend to pay off my house in the next 25 to 30 years. In fact, earlier than that, about 20 years from now. So on retirement, let's assume that we are retiring today. Let's assume that we are 62, we are 57, whatever your retirement age is. Let's assume that you are at that age. And what would your expenses be at that age? But you actually assume that you are 67 or 55 or 52, whatever that number is today. And you just list down all your expenses of today. And then we'll extrapolate that for the next 25 to 30 years. And then we'll see how much money will we require to sustain the same lifestyle that we have today. So when I retire, which I'm assuming it's today, my mortgage will be zero because I'll not be living on rent. That's not in my plan. I just bought my forever home. I would want my mortgage to be zero. That's the reason why I've taken $0 in my mortgage. My utility bill for now is about $300 including internet. My property taxes are $550 per month. These are all monthly expenses. My home maintenance I've taken at $250. It could be less, it could be more. I've just taken $250, which on average we have spent in the last 1 year when we had our house. It was less than that because of the new house, but I've just taken $250 for now. Car payment, I'm assuming when you retire, I would not have a car payment. So I have $0 listed here. Car insurance, right now I'm paying about $180. $250 is gas. I do about 3.5 tankfuls every month. My office is not very far from my place. Your number can be very different here. Groceries about $800. Sometimes you spend a little bit more as well. Our parents live with us, so it depends, every month. But then we eat out also less if more food is being, made at home. But again, this is just my number. Childcare expenses, even if you have kids, when you retire, your kids would be independent and therefore your childcare expenses would be minimal. And therefore I've taken $0. So whether you have kids or you plan to have kids or not, or if you have kids, either ways, your kids will be independent enough to not rely on your income. And therefore I've taken this as zero irrespective. Phone bill. Right now, I'm paying about $115. Eating out, I've taken about $500. Sometimes it's more, sometimes it's less. Depends, if it's a Diwali month or whatever, right? So I've taken $500 on average here. Shopping and fun, we do spend about $500 to $600 per month. I've taken $600. Travel, we try to budget about $10,000 per year on travel. That divided by 12 is about $800. We love to travel. We actually want to do more of this when we retire, but let's take about $800 for now. And other miscellaneous, medical expenses, whatever, right? Some incidentals, we have to go to India, whatever that is, that's $500 per month. And that makes our monthly expense just under $5,000. Now, these are the expenses that I have today. And this does not include my mortgage because I will be mortgage free. It only includes all the other expenses, which are home related, property taxes and everything. Now, if I increase this in the next 30 years by 3% every single year, I would require almost $11,500. So this $4,845 will more than double in expenses by taking 3% inflation. That basically translates into an after-tax income of $137,000 per year. And this $137,000 at 33% tax rate. Now remember, I've taken an average tax rate. It could be more as well, but at the 33% tax rate, this would amount to about $207,592 of passive income, because you're not earning anything else on retirement, of passive income that you'll need to sustain yourself for the next 20, 30, 10, how many years you live after retirement. That is a crazy high number that at least I got shocked when I saw. And you'll see that all these expenses that I've taken, they are not luxury expenses. They are normal expenses that you will incur even if you don't have any rent or mortgage to pay. And the way I derived this $5,189,800 is that, let's assume in an ideal world, I had this amount of money. If I use 4% of this every single year, and this money, the lump sum amount that I have, this grows by over 4% every single year, I'll never run out of cash. That's one, because if this $5.2 million grows at, let's say, 6 to 8% every single year, I can withdraw 4% plus inflation every single year, and this money will actually not deplete, or it will deplete at a very, very low rate. And if you do a 4% of 5,189,800, this comes to about 207,592. So I've done a reverse calculation from what I need as gross income on retirement annually, and that's how I came to this 5.2 million number. So when I say that I want to retire with $5 million, I don't mean $5 million per se in assets or whatever. All I mean is that I want assets which are worth over $200,000 per year to me before tax, because that's the money that I require in passive income to have a peaceful retirement. Now, of course, you can change these numbers. Let's say you are someone who doesn't like having a mortgage. You don't want a primary home, and you're like, no, Navjot, I'm okay, living on rent. Now, a home like a townhouse in Kitchener would cost you about $2,800. It could be a lot higher if you want to live somewhere else. But let's say $2,800 in rent. I'm just changing these numbers, and I'm just trying to understand how much money would you require, on retirement. Pre-tax, right? So $2,800. Home utilities, I'll still take it at $300 because that's the money that you will still spend. $550 of property taxes, so you don't have to pay property taxes when you are paying on living on rent. Home maintenance will be a lot less. Let's take about $100, not $250, because you're not, like plumbing breaks, everything, but you can actually call the landlord. Car payment, car insurance, gas, $800 of grocery, phone bill, eating out, everything else, I'm just keeping the same. Now you can change these numbers, and that actually gets me to about $7,000 of, expenses. So my total expenses become $7,000, extrapolating it to the next 25 to 30 years at 3% inflation rate, including the, rent on inflation, because the rents will increase unless if you upgrade, and the rents will actually increase by more than 3%, but let's not assume that. You would need about $16,500 of post-tax income every single month. That translates to almost $300,000 of gross income on retirement if you are still renting. And that brings my FIRE number, or my financial freedom number, to over $7.4 million, just about $7.5 million. Now, I'm not suggesting whether you should buy a home or not, but personally for me, I would want my expenses to be as low as possible when my active income is zero. Because if something goes wrong, if the stock market goes down, let's say I invest the difference of my rent versus my mortgage right now, and I have a sizable portfolio, and it still translates to about $300,000 of income, but I'll have all my assets tied up into one asset class, and that asset class, if it goes down, I might not be able to take out 4% that year. And that's the reason why I want to have a well diversified portfolio for retirement, because at retirement, I would have less control over my ability to work, and therefore the more diversified my investments and my overall portfolio is, the better it is. So coming back to this number of $5.1 million, or whatever this number is, the passive income that I need at 4%. So 4% of this number is about $207,000, and that's what I'm after. So I'm not really after the $5 million. I'm after the passive income on retirement of $207,000 plus a bit of primary home, like we discussed. Now, let's break down the portfolio. The mission is to get to $207,592 of passive income on retirement. For me, that's in 25 years. Breaking down the portfolio, I want to be mortgage and rent free. That's the first one that I want to do. Now, I bought my first home in 2020. Now, I technically bought my condo as well around that same time. But the home that I'm selling right now, and for those of you who don't know, we just sold our first home. and we upgraded to our forever home, which we'll keep for another at least 20 years. The first home that we bought was about $635,000. We bought it in 2020, and the sale price for this particular home in 2024, we just sold it, and I think the closing is this month, in fact, is about $825,000. The outstanding mortgage on this particular house was about $516,000. I actually paid a 20% down payment, just over 20% down payment, because I'm self-employed. I had to do 20% down payment. All that is long story and probably for another video. My net proceeds after 5% expenses. So obviously when you sell a home, you have expenses. Those 5% expenses, if I deduct those, my net proceeds were $270,000. Now, I did my calculation on my next purchase based on this net proceeds, because you can actually calculate the net proceeds by taking approximate amount that your home will sell for. My forever home costed me $1.2 million, and this number was actually arrived at how much money would I get from my sale of the first home. The down payment plus closing cost for this particular home was 20% down payment which is $240,000, plus about $33,000 of closing cost, which is land transfer tax and stuff like that. So the $270,000 that I got, I put in another $3,000 to close this particular home, and my outstanding mortgage on the new home is $960,000. Now, all this sounds like these are made up numbers, because they are. Because all my decisions are based on number, I actually determined the price of my forever home that I was buying now based on the numbers that I did on the net proceeds of the house that I was selling. Because my decision to buy the home that we are moving in this month was based on maths and not emotion. Now, like I said, I'm 37 and I want to pay off this house in 20 years. Now, I can't do it in 25 years. I've taken a 30-year mortgage. It's easy to pay off the mortgage 5 years early, because all you need to do is make about $5,000 to $7,000 of payment every single month, which is like an additional mortgage payment, let's say every single year, sorry, not month, year. You make an additional 13th month payment, and you can pay off the mortgage at least 4 to 5 years early. But I want to do it 10 years early, because this is my primary home. I don't want to leverage this anymore. I just want to pay it off so that I can retire as soon as possible. That's why I will be mortgage free at 57. And to do that, I'll need an additional $15,000 per year towards my mortgage. So I'll have to put every single year additional $15,000 on my birthday. And the reason why it's on my birthday is because I'll remember that. That would be my birthday gift to myself. I'll just put $15,000 and I'll save the entire year for that, and I'll put it towards my house so that I can gift myself 10 years of less interest and be mortgage free before I turn 60. So how did I come to this 15,000 number? I love Dave Ramsey when it comes to paying off debt. So I went to Dave Ramsey's calculator on ramseysolutions.com, which basically tells me how much money I need to put every single year, and I'll just do the calculations for myself. So the original loan amount is $960,000. The date of first payment, let's just take September for easy numbers. So September 1st, 2024. Loan length is 30 years. And even though my interest rate is high, but it's only for 1 year because I'm self-employed and I was just 2 months away from filing my taxes, and that's why my interest rate is over 6%. But let's assume that my interest rate would be 5%, which will be in the next year or so. For most people, it will be less than 5% for most of my clients, but let's take 5% for easy numbers. The next step is original loan amount, which is $960,000. Now, extra payments that I will be making. So let's assume that I make $15,000 of extra payments every single month, and I do that on my birthday from next year, which is 11th November 2025. No, 2025. And I hit on calculate. And I change this to yearly, and this will basically give me that I will be paying, total time saving would be almost 10 years. So a 30-year mortgage will be paid off in 20 years, and I'll be paying almost $300,000 of less interest, $328,000. It's right up there. So I'll be saving 37% on interest and 33% faster, and that's where the 15,000 number comes from. You can actually just download this calculator. You can just go to the description. You can link, you can just click on the calculator and do the calculations for yourself. But that's how I got 15,000 number. Now, I'm not trying to say whether $15,000 is less or more. Of course, $15,000 for a lot of people, including me, is a lot of money to put every single year. I'm not talking about how I'll achieve this 15,000 number. All I'm talking about is this is what it takes to have a peaceful retirement. So $15,000, if you're buying a house like this, is what it takes to retire in 20 years mortgage free. And the third important point here is in 20 years, there's a chance that we would want to downsize. I'm not even talking about what this house will be worth. It doesn't matter what this house will be worth. It could be worth $1.2 million that I bought it at. It could be worth $600,000. It could be worth $2.5 million. It could be worth $3 million. It does not matter. What matters is that I'll not have a mortgage payment when I retire. And that's the only thing that matters when you have zero income on retirement. But if the house value goes up, I would have the option of downsizing and I can invest the difference into the stock market that will contribute towards my retirement. But right now, I'm taking that number as zero. All I'm saying is that whatever amount I sell this house for, if I want to downsize, I can actually buy a condo or whatever in a very nice location for the amount of money that I'll have. So that's the first step, but that actually does not get us close to $207,000. We are still at $0 of active income. This is just what keeps this number at 207. Otherwise, this number will be $100,000 more if I'm still paying a mortgage or staying on rent. So the next most important step that will get us a little bit closer to this particular number, $207,000, is investing $2,500 per month in the stock market. That's my budget for every single month. I am starting with a portfolio of $75,000 because, like I said, I've been investing for the last 4 years since I came to Canada. Now, the first year we did not invest a lot. Our TFSs are maxed out, and that's where the portfolio of $75,000 come from. This includes about, I think, 15% of appreciation. All this can actually be seen on Blossom, which is an app where you can actually see my portfolio. And if you want to check it out, you can just go to the description and check my portfolio out. I will now be adding $2,500 per month. I've been doing that for almost a year now. Every single month, I'll be adding this particular amount in these particular ETFs. Now, I made an entire video explaining what these ETFs are, but you will see that these are well diversified. VFV is basically US top 500 companies. It's an ETF made of US top 500 companies, which is also called S&P 500, and $1,000, which is 40% of my portfolio every single month, goes towards this. XQQ is US tech companies, that's 20%. Then India top 50 companies, ZID, which is basically Nifty 50, a little bit different than Nifty 50, but just for simplicity, it's Nifty 50 that I invest about 20% of the portfolio, and the remaining 20% goes into Canada top dividend companies. Now, I do change these somehow, sometimes the last bit, where I sometimes invest into TD, I sometimes invest into an undervalued stock. Now, this is more advanced technique. I've been doing it for 4 years, but if you are starting out new, I would not recommend diversifying too much into individual stocks. Only if you have a habit of doing this every single month and you feel more confident of analyzing stocks, only then you do that. But to start off, I think this is a very well diversified portfolio. It's better than not investing. Now, in order to understand the returns that I'll get from this particular portfolio, let's go to the calculator.net calculator. It's called the investment calculator. I'll again link this in the description. My starting amount is $75,000 because that's the amount of portfolio that I already have. You can start with zero if you don't have any, or whatever your number is. For the next 25 years, because that's where I want to retire, at 62, ideally around 60. I'll talk about that in a bit as well. The rate of return, let's assume at a very, the average return for the last 50 years in the stock market in S&P 500 has been over 8%. So there's no reason to believe we'll not get, that. But let's say we are pessimist and we want to just see how much return we have at 6%. 6%, and the additional contribution that I'm making every single month is $2,500 beginning of every single month, and I hit on calculate. Just make sure that you have these calculations nailed down. It's very simple to do. I hit on calculate, and you'll see that at 6% return for the next 25 years, and if you are younger than me, you can do 30 years, 35 years, 40 years, whatever your age is, depending on when you want to retire. And it will come to almost $2 million, just over $2 million. If this return is 8%, which I feel it will be close to $3 million. And if you get a 10% return, you invest in India or whatever, you are a maverick of investing, you would end up with over $4 million. And that's the numbers that I have on this particular slide. If my portfolio for the next 6 years or for the next 25 years grows at 6% to 10%, I'll have anywhere between $2 million to $4 million in net worth. Let's assume in between, which is about $3 million. Now, if I take a 4%, let's say at 62 in 25 years, I'll be 62. I start withdrawing 4% and this portfolio keeps on growing at 6 to 8% every single year. I will have a disposable income of $117,757 pre-tax every single year. So of this $207,000 per year pre-tax money that I need in passive income, I can actually get more than 50%, almost 55% from my stock investing portfolio. So by doing this, I'm 55% closer to my target. The second thing that I want to do is buying 2 cash flow properties, and I'll give you the calculation on that. Let's assume that you have a purchase price of $500,000. The rent is $3,500. Now you might ask, oh, Navjot, where do you get $500,000 properties with a rent of $3,500? First of all, I would highly recommend that you join our value deals group, where we do share a lot of these properties that cash flow very well. Second of all, I think most people only look at cash flow investing only in Canada. I don't understand why. I look at North America. My best investment is actually in the US, where I bought a $449,000 building with investors, and our overall rent from that particular property on day one was $5,600. This is all in US dollars, $5,600, and that has now increased to about $7,000, and our property value has also increased by about to about $700,000. Now I did make a video on US investing. It will be on my channel, but what I'm saying here is that if you are feeling that you cannot get a $500,000 property and get $3,500 in rent, you are wrong. It's just plain simple. You can in fact get for a much lower price and get a much higher rent if you look at North America as a place to invest and not just Canada. More on that in subsequent videos, but let's talk about the mortgage payment on this. The mortgage payment on this, assuming you do a 20% down payment, is about $2,000. Property taxes are $300. Insurance is $130. Maintenance is $150. I have a similar property in Calgary. That's why I know that these numbers are right. Property management is $350. I've taken a little bit more. It's 10% basically. And vacancy rate, which basically means that not all months will be rented out. There will be certain months where the tenants are changing. There will be some vacancy. So I've taken about 5% vacancy, which is about $175. This 5% and 10% is based off of rent. So 10% of rent is $350, which is property management, and 5% of rent is $175, which is vacancy. Now, overall, if you look at it, the expenses come out to $3,105. Our rent was $3,500. So therefore, the cash flow that we get is around $400. Now, when you're talking about retirement, we need to understand 2 more terminologies, and those are very important. And the first one is net operating expenses. Now, net operating expenses are all the expenses minus the mortgage. So let's assume that we had 0 mortgage on this particular house. So you bought this house in cash. Your net operating expenses will be 1105, which is basically addition of all these red items minus the mortgage. So property taxes, insurance, maintenance, property management, vacancy, if you add this all up, it will come to about 1105. And the net operating income, and this also does not include the mortgage, will be 2395, which is basically cash flow plus the mortgage payment, because you don't have a mortgage payment. This particular number is the most important number when you are buying a property for retirement. And the reason for that is in 25 to 30 years, this property will also be mortgage free, and therefore it will give you a cash flow of 2395. Hopefully, I will not have a mortgage on at least 2 properties. So in 25 years, the rent from this particular house at 3% year on year return increase. Now, my investments will mostly be based in Calgary and in the US, and you don't have a rental cap there. I personally don't want to invest in Ontario. I have a couple of investments here, but I don't want to increase that investment side. In fact, I'll be divesting everything in Ontario except for my primary home. I'll be investing mostly in Calgary and in the US, where I can increase the rents with the market rates, and I don't have a rental cap there. So the rents would be at 3% year on year in 25 years, would be around $7,300. My mortgage payment hopefully will be $0. And like I said before, if you pay the 13th month payment, which is one additional payment every single year, you can actually pay off the mortgage 4 to 5 years early. So it's not difficult to pay off 30-year mortgage in 25 years. And that's what I intend to do with the 2 cash flow properties that I have. The net operating expenses, let's say they also increase at about 3%. So the 1105, the net operating expenses that you see here, that increased to about 2313 because of inflation. And the cash flow, if you subtract rent from the net operating expenses, will be about $5,000 every single month. If you multiply it by 12, that will be $60,000 per year. And if you multiply it by 2 cash flow properties, it will be $120,000 per year. And that's what gets me to 100% of my target. So the goal was to get to a $207,000 of passive income per year gross before taxes at the age of 62, which is 25 years from now for me. And the 3 breakdowns here are: number 1, buying a primary home and then adding $15,000 every single month by paying off the mortgage in 20 years. So that's the step number one that we need to do. The second step that I'll be doing is investing in stock market $2,500 per month for 25 years at 8% year-on-year return. That will give me a portfolio of almost $3 million and an income at 4% every single year of about $117,000 on retirement per year. Again, this is again pre-tax. Now, by the way, this $117,000, a bit of it will also be my TFSA portfolio, which I can withdraw tax-free. So that's the reason why I have not taken more than 33% of tax, because a lot of these things that I'm doing will also be tax sheltered. And I'll probably make another video, or you can talk to a financial planner, on how to do that. But that's the reason why I've taken a 33% tax rate, because I think there will be many opportunities to save taxes by just how you allocate your portfolio. The third one is real estate, which is 2 cash flow properties with NOI, net operating income of $2,500 per month. So I'll be investing in 2 cash flow properties. I already have 4 properties. 3 of them are cash flowing, and those are the properties that I'll consolidate into 2 or maybe 3, and I'll talk about that in my next slide. But the NOI was if you do not have a mortgage. So your rent minus your net operating expenses, assuming you don't have any mortgage, should at least be $2,500 when you are investing in the property right now. If you're investing tomorrow, that's your NOI. It should be close to that. The income after I pay off the properties, let's say in 25 years, will be about $120,000 per year. And you are not paying off this property, the tenant is. And while the tenant is paying off the property, you're still getting cash flow every single year that you can reinvest into your stock portfolio, or you can reinvest into your primary home. And that's another thing that, that's another topic for another discussion, but that's also cash flow that is contributing to your income every single year till the time you are mortgage free on those properties and you are getting an income of $120,000 per year. If you add all this up, you are at $237,000, which is $30,000 more than what our target was. And that's my retirement plan if I am to retire in 25 years. However, I want to retire 5 years early before 60 at 57. And to do that, and that's how crazy and powerful this is. If I want to retire 5 years, just 5 years early, just imagine, instead of retiring in 25 years, I want to retire in 20 years, I'll have to do some crazy stuff. First of all, I'll have to still pay off my house, $15,000 every single year of additional payments to pay off the house in 20 years. That was always the plan. That's still the plan, irrespective of whether I retire at 57 or 62. The second one is crazy to me. Instead of investing $2,500 per month, which is the plan right now, I'll have to invest $5,000 per month. I'll have to double my investing budget for the next 20 years, because now I'm not investing for 25 years. I'm only investing for 20 years to have almost the same portfolio, slightly higher, but almost the same portfolio. So that when I withdraw 4% from it, I'm still at about $128,000 per year. So in order to retire 5 years early, just 5 years early, I'll have to double my investing budget every single month, which is absolutely crazy. But that's what pushes me to make these videos. That's what pushes me to do better. That's what pushes me to make more money, because I know that I'm 37 and I want to retire in 20 years. And if I have to do that, I have to be able to invest this amount of money. That's what drives me. The third thing that I'll be doing, instead of buying 2 cash flow properties, because now I want to pay off not in 25 years, but in 20 years, because that's my retirement goal now. Instead of buying 2 properties, I'll want to buy 3 cash flow properties with the same NOI of $2,500 when I buy, but I sell one to pay off the other 2 early. So instead of, paying off everything, all 2 properties 10 years early, that will be a lot of money that goes out of my pocket. I think that it will be easier, and we can actually do the numbers in a different video, but it will be easier to buy 3 properties. I already have 4 with partners, but I can actually buy 3 properties and sell one to pay off the other 2 early. And still in 20 years, I'll be getting an income which is less than $120,000, which I had in my previous slide, because that was after 25 years. This is after 20 years. And therefore, my income will be about $108,000 per year at 57. And my annual income is still around the same of what our objective was, $30,000 more. But yeah, that's the stretch goal that I've given myself for my retirement. I want to really retire before I turn 60, and that's what it takes to do that. Before I close this presentation, I have one more slide where, and this is an important one, what if I die early? What if, we plan for everything, but you don't know where life is taking us. We can plan to live about 100 years or even more than that with the technological advancements that are happening in. But what if that doesn't happen? What if, so if we have to plan for that as well, because you can't have 1.5, 1.7, 1.8 million dollars of debt and leave that for your family. And therefore we have a term insurance, and I don't talk about any other insurance. Whole life, all this, is noise, right? Just take a term insurance, and we have taken for me and my wife $2 million per person, and we are paying a combined of $220 per month for that. It's just over $220 per month, 120 for me and 100 for my wife, and we have a coverage of $2 million per person for the next 25 years. Now, we took this 3 years ago when we came to Canada, almost around that time. So therefore, the premiums are a lot cheaper because we were relatively young at that time, but it's very important that you do that. And the reason why you do that is because I want the debt to be paid down if I go away. $960,000 of primary home, that's the debt that I start with. I want that paid off completely so that there is less financial stress on a monthly basis. $800,000 of investment properties. Remember, we talked about having 2 properties, 3 properties, let's say, but $800,000, let's assume that you have $800,000 of debt on your investment properties with a net operating income of $5,000. This gets paid off and this becomes cash flow, $5,000 per month starting tomorrow. And then we also have $240,000 left because it's a $2 million policy, which is excess cash and stock portfolio, because I do have investments as well. All that is excess for anything that we require, because now there'll be less income coming in as well. But this actually protects the family. This actually protects you while you are building your assets and paying them off. And in 25 years, once those assets are paid off, you are anyways which way set, and therefore you would not need the death benefit after 25 years. At least that's the plan. All the websites and links that I used in this video are in the description. The retirement calculator where I calculated my 5 million number is also in the description. Do download that as well. I know it's a lot to take in, and I lost sleep for a long time after I got to know that what I'm doing is not enough. But I had to come to terms with that. I cannot live in denial, and therefore I made a plan of making more money so that I can meet my investing goals, so that I can retire peacefully. That's all I have for today. If you are someone who wants to retire in India and not Canada, I would recommend that you watch the next video, which is retiring in India, and I have a plan for that as well. That's all I have for today. मिलते हैं अगली वीडियो में, तब तक के लिए बाय बाय.